Good afternoon and welcome to the lecture 29 of ETC 779. In this lecture, we are going to cover all the details pertaining to working capital. We will go through what working capital means, what are the different components of working capital, how working capital is determined. Then we will also try to find out what are the different sources of financing of working capital. We will see short term sources, we will see long term sources of financing, and then we will try to find out why the management of working capital is needed and what measures we must take in order to economize on the employment of working capital. You will find that this aspect is very important as far as the management of construction company is concerned. It is normally said that working capital is like blood to the body. So, you know how essential the blood is for the body. It is in the same line working capital is required for the functioning of a construction company. So, we will just try to quickly review what are the components of working capital. These things yesterday we could see. For example, working capital, we define it as the capital which is required to meet the day to day expenses of an organization. So, in other words, it is the excess of current assets over current liabilities. Now, current asset means any asset which can be converted into cash in the normal course of business within 1 year. This point I stressed and we discussed the importance of this period 1 year. So, any asset which you find that can be converted into the cash form within a period of less than 1 year, we treat them as current assets. Then you have current liabilities, and under current assets you have cash or the bank balances, stocks, the outstandings, the prepaid expenses and various deposits that you have. Then coming to the current liability, it is basically the money owed by a business or any liability which is to be paid within 1 year. Here also the period 1 year is important. So, any liability which you find that you have to pay it within a period of 1 year, we are considering them as current liability. If you try to look at some of the components of current liabilities, you will see the vendor credit is one of them. The advances that you receive from client, for example, the mobilization advance, it could be the secured advance, the sales tax payable and other payable items, these are to be treated under current liabilities. Similarly, the deposits that the main contractor receives from subcontractors. For example, the main contractor or the general contractor must be receiving some amount in the form of bank guarantee. So, these things are part of your current liabilities. This exercise already we have seen, in which you were told to identify the following items and classify them whether they are part of current asset or current liability. Now, we also defined the working capital in our previous lecture. If you look at this particular slide, we defined net working capital as the difference of current asset and current liability. We also defined gross working capital as the total current assets. Now, just in the beginning I was mentioning that working capital is to business what blood is to the body. So, it is that important. Now, we need to know why at all we need to determine the working capital requirement. Why after all we are dedicating one full lecture on the working capital part. This must be very important. That is the reason we have chosen to emphasize on this particular aspect. So, you will find that the objective of any financial decision making is to maximize the shareholders' wealth. After all, the company is into business to maximize its profit and thereby enhancing the shareholders' wealth, because the company is founded on the money supplied, or rather money received from your shareholders. So, naturally it is one of your objectives to make them wealthy. Now, it is necessary to generate sufficient profits, then only you can satisfy your shareholders, because if they do not get constant money from your firm, they will try to look towards some other firm. So, whoever gives profit to them on the regular basis, they will be attracted towards them. So, it is essential for an enterprise to provide some incentive to the shareholders in the form of maybe dividends or some other type of profit appropriation. The idea is that your shareholders must be satisfied. So, in order to satisfy them, you have to earn profit on regular basis, because until and unless you have generated profit, you won't be able to part with it. Now, in order to generate more profit, naturally you would like to have more sales, because until and unless you do more business, there are less chances that you will get more money or more profit. Now, the extent to which the profits that can be earned will naturally depend on the magnitude of the sales. So, that is why companies try to enhance their sales with the prime objective of increasing their profit. Now, you will realize that for achieving a particular level of sales, you need to invest your own money also, because if you try to think, the sales do not convert into cash instantly. We will see this when we look and discuss on the operating cycle. So, what happens? The moment the company makes sales, the cash is not immediately realized. So, it follows a operating cycle. For example, as a contractor, let us say you have received some order for constructing a facility or constructing some infrastructure. Now, you may as a contractor receive the mobilization advance, or you may not receive the mobilization advance. Now, in both the cases you have to start the work. So, what happens? You invest your own money. This money either you can borrow it from somewhere, or you can spend it from your retained earnings of previous projects. So, this money you utilize for generating the sales. Now, sales for the construction company would mean invoicing. Do this item, do that item, do this activity, do that activity. So, once you perform these activities, you are now eligible for raising the bill. So, suppose you have done a work of some value for a particular month. It could be maybe 500,000 for that particular month. So, for raising this invoice, you need to have some money with you, because you have to pay for the materials, you have to pay for the labor, you have to pay to your subcontractors, you have to pay towards higher charges of equipment suppliers. So, in the beginning, when you do not have money from this particular project, you need to borrow it from somewhere, or you need to plow back your earnings through previous projects. Now, once you have raised the invoice or raised the bill, you may get the payment depending on the terms of conditions. In most of the project, you will find that the clients give you some ad hoc payment, maybe about 75 to 80% within submission of bill, within next 7 days of submission of bill, and the remaining they may take about 2 to 3 weeks time. So, on an average you will find that the payment delay is of the order of 3 to 4 weeks. So that means during that particular week also, during those particular week also, or those particular period also, you need to have your own money. In addition to all these, you also require money for setting up your site offices, your labor camps, developing site infrastructure. So all these require certain amount of money. So if you try to look at the cycle, it is of this order. It takes this form. So you started with your own cash to purchase maybe raw materials, to spend on labors, to spend on plant and equipment. Now, using these ingredients, you are in progress of some work. So that we define it as work in progress. So what has happened? Raw materials, labors put together has got converted into work in progress. If you remember, all these are assets. What is happening? The most liquid form of asset, which is cash, is getting converted into raw materials and then into work in progress, and then ultimately you get finished goods. Now these finished goods may go for sale. Now these sales, sometime you may directly get the payment in the form of cash. So you may have some cash sales in the context of manufacturing industry. In construction industry, this cycle really doesn't work exactly in this manner. Now the sales can take place in two ways, either in the form of cash or you have on credit basis. So once you have sold it on some credit basis, so you have debtors. These are again your assets. Now these debtors, when they pay back to you, you get cash. So this is how the cycle operates. In the construction, what happens? You employ your own money to buy raw material, to spend on labor, to spend on plant and equipment, to spend on subcontractor, to spend on establishing site infrastructure. Then once you have put in all these facilities, you produce some bill, or rather you raise some invoice. Those invoices gets cleared after a certain period of time. The invoices get converted into cash, some portion of cash immediately, and the remaining portion could be treated as debtors or outstanding. Now once you receive this money, that is again coming at first position, that is the cash. So this is how the cycle operates. Now imagine the situation in which this cycle is reduced to, rather this cycle takes negligible time to complete. For example, you have a cash with you, immediately you buy raw material, without any gap you put the labor, without any gap you are having work in progress, and that gets converted into finished goods quickly within no time. Finished goods are sold immediately within no time, and you realize the payment within no time. Will you require working capital in that case? No. So if the entire cycle gets completed within no time, no company would require working capital. But if you try to look in reality, the cycle takes time. The entire cycle, depending on the type of business, may take anywhere between 1 month to maybe 3 to 4 months. If you are working for a heavy industry, it may even take 6 months. Suppose a shipbuilding industry. So from the time they plow the cash into the business to the time they realize the cash back from the client may take even 6 months or maybe even a year. So the idea is, the lower is the cycle time, the lower is the operating cycle time, the lower is the requirement of your working capital. The higher is the operating cycle time, the higher would be the requirement of your working capital. Now, if you remember, we had defined working capital, rather net working capital, as the difference of current asset and current liability, whereas we had defined gross working capital as the current asset itself. So, using this cycle, you can understand that if it would have been possible to complete the entire cycle within no time, there would be no requirement of working capital. But since this cycle takes time, a company needs to have certain amount of money known as working capital in order to operate its business. So, that is why you require, or any company requires, working capital. Now, you will find that if the company is into the same business throughout its life, there would be very little fluctuation in its working capital requirement. But there are different situations which demand the changes in the working capital. We will do one exercise in which I will give you certain data and you will be told to find out the requirement of working capital for that particular company. But for the time being, we will see what are the different reasons due to which the changes in the working capital takes place. Now, the first reason could be the changes in the level of sales and or operating expenses. So, if your sales are going up and if your operating expenses are also changing, you will find that your requirement of working capital would also change. Now, similarly, if there is a policy change, there could be change in the working capital. For example, right now you may be maintaining a stock of 15 days as far as cement is concerned, but tomorrow when your management finds that there is no point in keeping the stock of cement for 15 days, let us try to keep it only for 7 days stock, you will find that your working capital requirement will come down, because now you are keeping less inventory or less stock. So, that is why it is said that wherever there is changes in the policy, there could be the change in the working capital demand also. So, it is desired that whenever any major policy changes take place, there must be a recalculation of requirement of working capital. Similarly, when you find that there are changes in the technology, the requirement of working capital may change. For example, right now some company may be using too much of labor. Now, tomorrow they come out with some equipment which can replace the labor to a great extent. So, you will find that there could be change in the working capital requirement. So, these are the prime reasons through which you will find that the changes in the working capital take place. Now, in order to run the business smoothly, you always require a minimum amount of working capital. Now, this minimum level is called the permanent part. So, no matter what changes take place, either in the sales or operating expense, or on the policy changes front, or on the changes in technology front, this part the company always keeps to maintain. So, this minimum level is known as the permanent part of working capital. Now, whenever there is a fluctuation taking place, we supplement this permanent part with the variable portion of working capital. So, we have two components of working capital. One is called permanent part and the other one is called variable part. Now, depending on the business, the level of permanent working capital as well as the variable working capital may change. For example, suppose some company is into manufacturing bricks. Now, his demand would fluctuate according to the season. For example, if it is a rainy season, if it is a winter season, or if it is some other season, you will find that requirements vary, because the level of construction activity would also vary. So, there could be seasonal fluctuation in working capital also. So, out of all the seasons, you try to take the minimum level which is to be maintained throughout the season, and then any additions you want to have on this minimum part can always be supplemented through the variable portion of working capital. Now, this is how we define the types of working capital as permanent and variable working capital. So, as you can see from this particular slide, the permanent working capital part is needed for the enterprise to carry out minimum level of activities. Hence, it should be financed from long term sources. We will see what are the long term sources and what are the short term sources when we discuss the sources of financing of working capital. For the time being, you just understand that the permanent working capital part is to take care of the minimum level of activities of the organization, whereas the variable part, it fluctuates with the level of business activities, and hence normally they are financed from short term sources. For example, bank overdraft, cash credit, bill discounting. These things we will discuss in detail when we discuss the short term sources of financing of working capital. Now, these are some of the factors which affect the working capital: the season changes, the location of the plant. You will find that they have some impact on the working capital. Okay, this is also one of the important factor. For example, what are the financial position of the client as well as your subcontractor. For example, you find that once you have started a project, your client may be facing some financial problems. So, he may not be able to pay you on a regular basis. So, there may be constant delay in releasing your payments. So, under such situation, your working capital requirement would increase, because the outstanding amount will go on increasing. So, you need to run your business. If you want to run your business smoothly, if you want to run your project smoothly, you need to have investment required to support you for longer period. Now, similar is the case with subcontractor. Suppose you find that your subcontractor is defaulting. That means he is not able to pay to his workers. What will happen? You may have to pay him some extra money to take care of his financial problems. So, all these also will have negative impact on your working capital. So, if you find that your client is having a financial problem or your subcontractor is having financial problem, that will affect your working capital requirement. Then similarly, you find the change of government policies, that may also have the effect on the working capital. Suppose the government comes out with some major regulations. They tell you that the import duty has increased, or there are certain taxes which are to be levied additionally. So, all these will be part of your taxes, part of your cost, and so naturally in order to run your project, you may have to take care of this additional burden also. So, any increase in levy, duties, taxes, royalties, octroys, all these things try to increase your try to increase your working capital requirement. Now, of course, this is related to Indian policy. Normally in some countries they have a central bank. In India we have a Reserve Bank of India. So, if they change the credit policy, that affects the interest rate, and thereby you will find that they also impact the working capital requirement. Now, one more thing that you need to consider is the ratio of current asset to fixed asset. That is very, very important in the context of working capital. Now, this ratio, basically the idea is how much should be the ratio of current asset to fixed asset. That is one of the decisions that you may have to take. Now, this again depends on the psyche of the manager dealing with the working capital. Now, you will find that there could be three kinds of possible approaches. One could be aggressive approach, other could be the conservative approach, and the third could be an average approach. So, you will find that an aggressive manager would prefer less of current assets than the fixed assets. Similarly, a conservative manager, you will find that they would stress more on the current assets than the fixed assets. An average manager would follow the intermediate path. So, these two, aggressive as well as the conservative manager, are the two extremes, and then in between you have a middle path, right. So, the aggressive manager tries to have less of current asset than the fixed asset, whereas a conservative manager has more current asset than the fixed assets. Now, I will tell you why this ratio is important with the help of an example. Let us take this particular example in which you are given the figure on sales, the earnings before interest and taxes, the fixed assets, the current assets, and the total assets. Now, ratio of current asset to fixed asset is also given. Now, we will try to see how does this affect our return on investment. So, you will find that under 1, which is conservative approach. So, column marked 1 is conservative approach, column marked 2 is average approach, and column marked 3 is aggressive approach. So, let us assume that sales figure in all the three cases are same, 50 lakhs, right, that is equal to 5 million. Now, let us assume that the earning before interest and taxes are all same, 5 lakhs in all the cases. Now, when it comes to conservative approach, the manager has employed a fixed asset of 10 lakh and a current asset of 8 lakhs. So, the total asset becomes 10 plus 8, which is 18 lakhs. Now, if you look the column under 3, which is aggressive approach, you find that the fixed asset employed by the manager is only 10 and current asset employed by him is only 5. So, what you find that he is having a total asset of 15 lakhs. So, when you try to calculate the ratio of current asset to fixed assets for the conservative approach, that is under column 1, you find this ratio to be 0.8 or 80%, whereas for the aggressive approach this ratio works out to be 0.5 or 50%. So, now when you calculate the return on investment, which is nothing but the earning before income tax or earning before interest and taxes divided by total assets. In the conservative approach, you are getting only 27.8%, whereas in aggressive approach, you are getting a return on investment equal to 33.3%. So, what this example illustrates is the ratio between current asset and fixed asset has an important bearing on the return that you get on your investment, even when the sale amount is same. So, you find that a conservative manager gives you lower return than the return on investment given to you or earned by a aggressive manager. So, this is what it is written. The example shows that for the same sale amount of rupees 50 lakhs, the variation in the ratio of current to fixed asset results into the return on asset varying from 27.8% to 33.3%, depending on the approach of the manager. Okay. Now, the next part of this lecture, we are going to cover the different means to mobilize fund for the working capital. So, under this we are going to learn what are the different means. In the previous part, what we learned was what is working capital, what are the different components of working capital, and what are the different approaches of managing working capital, why the working capital is required, what are the different components of working capital, and how the ratio of current asset to fixed asset affects your return on investment. Now, in this part of the lecture, we are going to see what are the different mechanisms to mobilize funds for the working capital. So, you will find that there are two major sources of finances. These are short term finances and long term finances. Now, in general, you will find that arranging short term finances are less costly compared to the long term finances, right. So, normally what people do is, depending on how much portion is your permanent part and how much portion is your variable part of the working capital, you decide on the proportion that okay, this much I am going to borrow it from my long term sources and this much I am going to borrow it from the short term sources. Now, here also the proportion, that means how much portion to get from short term sources and how much portion to get from long term sources, again depends on the person managing your working capital. Here again there could be three types of approach. One could be aggressive approach, other could be very conservative approach, and the third one could be average approach. So, in the case of aggressive approach, you try to have, in the case of aggressive approach, you try to finance the okay, before that we will see what is done in the conservative approach. In the conservative approach, the permanent part of working capital as well as part of the variable working capital is financed through long term funds. So, in conservative what you do, the permanent part as well as the part of variable working capital, you finance it through long term funds. So, what is happening? You avoid the risk, but you have to compromise on the profitability. Now, just the reverse takes place in case of aggressive approach. There the manager would try to have little of short term funds, right, and thereby he will try to maximize his gains. Now, the matching approach, we follow the middle path. So, the permanent part of working capital is financed through long term funds, and variable part you finance through short term funds. So, this you may even note it down, that in matching approach or the average approach, the permanent part is financed through long term funds, permanent part through long term funds, and variable part through short term funds, right. Now, when it comes to conservative, permanent part of working capital as well as part of the variable working capital is financed through long term funds. So, in this case you avoid risk, but at the cost of profitability. So, I have worked out a small example in which I have given you the current asset values for the three approaches: matching approach, conservative approach, as well as in aggressive approach. Now, the different interest rate for the short term credit as well as for the long term credit are given. Now, the tax rate is also given to you. Now, using all these three approaches, you have to find what is the return on equity. This, when you consider a debt equity ratio of 50%, you will find that the three approaches give you entirely different outcomes. Now, we actually see what are the different sources of finances for long term funds as well as for short term funds. So, when it comes to long term funds, I will just tell you what are the different routes through which you borrow the money. It could be issue of shares, it could be floating of debentures, it could be long term loans, it could be reserves and surplus, it could be fixed deposits. So, these are the different routes through which you mobilize the long term funds. We will go into each one of them in detail, but just I will try to give you the complete list. Now, when it comes to short term funds, you can mobilize through your internal sources such as depreciation fund, the taxation provision, the accrued expenses. Then through external sources you can borrow it from cash credits, overdraft, bill discounting, letter of credit, and loans for less than 12 months period. And then in addition to this, you have a trade credit. Now, each one of these, for short term financing sources as well as for long term financing sources, we will try to discuss in detail. Now, first we will try to discuss the short term sources, and in that you might have noticed that trade credit is one of the routes. Now, trade credit is very important in construction industry. The advantage here is that it comes with fewer restrictions and it is very simple as well as flexible. Normally, whenever a construction company buys certain materials, construction materials, for example, it could be aggregate, it could be cement, it could be steel, it could be timber, it could be plywood, there could be many construction materials. Now, these materials, when you buy it from your supplier, the normal construction practice is, normal trade practice is that they don't ask payment in cash immediately upon supplying you the material. Normally, they extend you a credit. The credit period in construction industry normally varies between 3 to 4 weeks. That means you take the material and then you will have to pay to the supplier, to the vendor within 3 to 4 weeks time. Now, if the company is reputed, they may even command a credit period of 4 to 6 weeks. Now, normally more than 4 to 6 weeks of credit period is not desirable, because once you insist for so many days of credit period, you will find that your vendors or your suppliers start loading the interest part onto the rates that they are quoting you.